An IMF working paper provides fascinating insights for the means of drastically reducing the debt-to-GDP ratio using the post-war years of 1945 to 1980 as a case study. Its conclusions are stark and will impact lower and middle classes profoundly. So today we check out how will be expected to help liquidate government debt. So let's dive on in. Now, this channel provides global macro insights and champions the importance of sound money in a world gone crazy, so please do consider subscribing. Now, this paper provides a startling insight into the complete financial repression toolkit that the IMF, governments and central banks have at their disposal. The paper is based upon the experiences of around a dozen different countries and their ways and means of successfully reducing debt to GDP levels following World War II. Fundamentally, this paper touts the liquidation effect. This is when controlled nominal interest rates are coupled with inflation to produce negative real interest rates. And that has the impact of liquidating the stock of outstanding debt. Yet it goes far further than this, as even when interest rates are positive, the use of effective interest rate ceilings, large-scale official intervention or other regulation and policies will be used to ensure that there is always a saving in interest expense to the government. In fact, we're seeing that right now. This is the financial repression tax, and this is just what we can expect, not just in the short term, but the process is to be accelerated into the medium and long term as well. So it's absolutely crucial that people are aware of these steps and what we can do to mitigate the effects. The authors of this IMF report outline the three key pillars of making sure the average householder foots the bill for liquidating the government's debt. First, explicit or indirect caps or ceilings on interest rates, with particular emphasis on government debt. Yet this approach will affect all interest rates. For instance, it could utilise explicit government regulation which could prohibit banks from paying any interest at all on demand deposits, while interest rates on savings will be capped as well. Additionally, interest rate repression could extend to ceilings on bank lending rates. Now, this would be enormously beneficial for the government in borrowing directly from the banks. Just consider how easy this interest rate repression could become when all bank accounts are transferred to the central bank and the competition for deposits is completely removed. Negative nominal rates, that's what we'll face under the conditions of CBDCs. But to that end, right now we already see enormous interest rate suppression. The so-called Taylor rule that suggests nominal rates should be 1.5 times the rate of inflation, we just aren't seeing right now. As Tavi Costa points out in this chart, that the Fed funds rate should actually be 9.3% today, according to the Taylor rule model and controlling inflationary pressures. Now, the key question is to determine whether they can actually keep a lid on this inflation. If they constrain credit for consumption, it would seem possible as long as credit flowing towards asset markets is actually maintained. No doubt about it, central banks are walking a real tightrope here, a tightrope that will necessitate targeting the maximum level for which yields can actually trade at. And we've already seen those interest rates appear capped already this year. Secondly, liquidation of government debt will require a rather dystopian sounding creation and maintenance of a captive domestic audience that facilitates direct credit to the government. This approach will require multiple layers of regulations to ensure a forced home bias in the portfolio of financial institutions, as well as more subtle measures such as requiring domestic institutions to hold government debt. Pension funds would be a primary target, yet as we discussed in this video, there's every reason to believe that this could also extend to banks and the depositors' savings in the more immediate term. Additionally, another option would be to impose additional taxes to investment speculation. Transactions such as equities, gold or cryptocurrencies could see further taxes. And this would act to encourage investment in government bonds. Third, there's the whole variety of other measures that could also be exploited and were enormously successful after the post-war period. These measures include direct ownership of banks at the very least extensive management of their activities. And as central banks extend their powers dramatically with CBDCs, the banking sector will see ever greater concentration. The largest, most powerful banks are key shareholders of the Fed. Consequently, their CEOs wear two hats, one as chief of their banks and the other as a key player in the rule of the central banking system. Without question, these banks will do the Fed's bidding to help ensure that a meltdown of government debt does not occur. Then there's BlackRock, the so-called unofficial fourth arm of government. Larry Fink, Jamie Dimon and co will be used to help shore up government debt markets together with cooperation amongst the developed world's central banks. And to that end, gains in equity markets will need to be cooled, probably via control of margin debt. Yet if equity markets require cooling, without question the attention will soon be redirected towards cryptocurrencies, particularly now with Bitcoin pushing for new all-time highs. And just this week we've seen the Bank of England Deputy Governor Sir John Cunliffe attack cryptocurrencies, likening them bizarrely to the growth of the subprime mortgage crisis in 2008. Yet the comparison is weak at best, given the dramatic increase in debt loads that facilitated the housing market boom and subsequent bust. The scale of margin debt in cryptocurrency markets is not in the same ballpark. Just to put this into perspective, US housing went up in value by over $2.5 trillion in 2020 alone, and this annual gain is greater than the total market cap for crypto. Nonetheless, regulation is without question coming, and if the gold market is anything to go by, it will be targeted at trying to limit price growth and increase volatility to help discourage investment. Without it, financial repression will not truly work. And say what you will about cryptocurrencies, but their ability to actually offer gains to low and middle classes across the world has been almost without parallel. They have helped to insulate many in countries such as Argentina, Venezuela and Nigeria from the ravages of excessive depreciations of their domestic currencies. Moreover, the growth of this new landscape is taking place at a rapid speed, where the adoption rate is growing faster than the internet in the late 90s, as we can see in this excellent chart from Raoul Pal. Personally, I believe everyone needs a little exposure to this. The risk-reward play is too great to miss. Yet we must be wary of increased regulation and surveillance of this market, which is certain to cause some price drawdown at some point very soon. Otherwise, the central banking cabal will lose complete control of the monetary system, and this is what really worries the likes of Sir John Cunliffe. So my overall strategy is clear: to get your money out of the banking system. Some crypto together with, of course, gold, silver, land and property seems a fair combination to me. Now, thanks so much for watching. Do join me on these alternative platforms on Odyssey, Rumble, BitChute. All the links are in the description below, and I look forward to seeing you next time. Bye-bye.